Hey everyone, welcome to This Explainer. If you're ready to really master the very foundation of the double-entry accounting system, you are absolutely in the right place. Today, we're unpacking the mechanics that keep, well, literally every single business on Earth organized, capitalized, and running smoothly. We're going to demystify the accounting equation together, and by the time we wrap up, you'll have a crystal clear understanding of the actual financial engine that drives every business out there.
So, you got to ask yourself, what lies at the absolute heart of accounting? It's a fundamental question, right? And the answer is something that every aspiring entrepreneur or seasoned executive or savvy investor absolutely needs to grasp. Whether you're running a massive global tech empire or just opening a small local coffee shop down the street, the financial logic operating behind the curtain is exactly the same. It all anchors back to one single core concept. Let's start with a foundational, kind of simplified concept to build our framework. Basically, a business is divided into two distinct realities: what it owns and what it owes. Now, the absolutely vital principle you must internalize right now is that these two realities must always unconditionally align. There's no magic money in business, right? Every single item the business has in its possession was funded by someone, meaning the business technically owes that exact value to a specific party.
When we translate that colloquial stuff you own into formal accounting jargon, we get our first pillar, which is assets. Whenever a business controls something of value that's expected to provide some sort of future economic benefit, it goes into this category. You can think of assets as the economic engine of your company. It's deployed capital that's just ready and waiting to generate revenue for you.
To make this super concrete, let's look at a few real-world examples. Assets can be highly liquid, like the cash sitting in the cash register, or accounts receivable, which is really just money your customers legally owe you. It also includes the inventory sitting on your shelves. And then it encompasses the heavier long-term items too, like plant property and equipment, land and buildings, external investments, and even intangible values like goodwill. And actually, goodwill doesn't just mean a friendly smile from your staff. It has a very strict financial definition involving brand reputation and acquisition value. Long story short, if your business controls it and it holds value, it's an asset.
Okay, so flipping over to what the business owes. We actually split this into two separate categories, and it depends entirely on who the lender is. First up, we have liabilities. This describes exactly what the business owes to third parties. It's your external debt. Basically, you went outside the company walls to get funding, and now the business has a legal obligation to pay it back.
These are the obligations that essentially keep the lights on and, well, the government off your back. Common examples of liabilities include accounts payable to your suppliers, loans payable to your bank, wages payable to your hardworking employees, and of course, taxes payable to the government. Managing these is absolutely critical for survival. If an outside party has a financial claim against your business, it lives right here. But wait, what if the business is funded internally? Like, what if it owes money back to the person who actually started it? Well, that brings us to equity. This represents internal debt. Now, it might sound a bit counterintuitive to think of your own investment as a debt, but remember, in accounting, the business is a completely separate entity from you. Because of that, any value the business holds that isn't claimed by outside third parties is technically owed back to you, the owner, or your stockholders.
So the crucial point is, when you bring those terms together, we get the undisputed law of finance. Assets equal liabilities plus equity. The total value of everything the business controls is perfectly, exactly equal to your external debt plus your internal debt. It's a beautifully simple yet incredibly powerful formula. It prevents money from just, vanishing into thin air. Every dollar has a source, and every dollar has a destination.
Okay, let's dive into this and put the equation to work by looking at a popcorn business. Because really, the absolute best way to lock this concept in is to see it in action from day one. So imagine starting a brand new popcorn stand. You take a crisp $5 bill from your own pocket and lend it to your new venture just to get things off the ground. The business now officially holds $5 in cash, which is an asset. But because the business is its own legal entity and it owes that initial seed money back to you, we record a matching $5 owner investment under equity. Look at that, our two realities are perfectly symmetrical.
Next, you head down to the local shop and spend that $5 on raw corn. You've just executed a fundamental business transaction, an asset swap. The cash is gone, and it's replaced entirely by inventory. So the specific classification changed, sure, but the total economic value remains solidly anchored at $5 on both sides. The equation doesn't miss a beat.
Now, to actually pop this corn, you're going to need a pot. but you're totally out of cash. So you go to a friend and borrow $10. This right here is your first use of leverage. Your cash asset instantly increases by $10. Simultaneously, because you now owe a third party, your liabilities, specifically loans payable, jump by $10 too. So your total assets are now $15, fully offsetting your combined liabilities and equity of $15.
All right, so you take that freshly borrowed cash and go buy your pot. Once again, you're just executing an asset swap. Your cash drops by $10, and a brand new equipment asset goes up by $10. You essentially converted liquid capital into a long-term asset to build out your business infrastructure. And the overall equation hasn't budged at all. The totals remain completely aligned at $15.
And now for the climax of our story, your very first sale. You fire up the pot, pop the corn, and manage to sell the entire batch at a 60% markup on your initial cost, bringing in total sales of $8. All your inventory is gone, but you're holding $8 in cash. Let's do the simple math here. If we take that $8 in incoming sales and subtract the original $5 cost of the raw corn, we are left with exactly $3. And that, my friends, is your profit. Now, $3 might seem like a really small numerical win, but make no mistake, this is a massive milestone. This is the entire point of business operations. You took raw materials, added labor and equipment, and generated entirely new economic value that literally didn't exist yesterday. But you might be wondering, where does that new $3 value actually live within our strict equation? Well, it falls under a specific form of equity called retained earnings. You can just think of this as profit held for future use. It's the ultimate goal of any self-sustaining enterprise. Because the business successfully generated this new wealth, it essentially owes this profit back to you, the owner.
So updating our final mini balance sheet to reflect this milestone, assets now consist of the $8 in cash from the sale and our $10 equipment pot. That is $18 in total economic power. And this is funded by our $10 liability loan, your initial $5 equity investment, and those $3 of newly generated retained earnings. 18 offsets 18. Every single dollar is meticulously accounted for, proving that the system works flawlessly from start to finish.
And this brilliantly illustrates our next core concept, taking a snapshot of the business with the balance sheet.
Zooming out from our little popcorn narrative for a second, this expanded equation actually forms the foundation of the balance sheet. Simply put, it's one of the most important financial statements out there, precisely because it is a snapshot of a business's assets, liabilities, and equity frozen at a single point in time. Investors, analysts, banks, they all obsess over this document because it strips away all the marketing fluff and PR spin. It reveals the raw, unfiltered economic reality of a company. You can look at this single sheet and instantly know if a business is drowning in debt, if they have enough cash to survive a recession, or if their operations are actually generating retained earnings. Bottom line, you cannot hide a bad business model on a balance sheet.
Real quick before we finish up today, if you're a focused learner who wants to intuitively grasp more of these foundational accounting concepts, but without getting bogged down in overly dense, boring textbooks, I highly recommend checking out a book called The Accounting Game, Fresh from the Lemon Stand by Daryl Mullis and Judith Orloff. It does a phenomenal job of taking these fundamental business structures and making them just as accessible, engaging, and easy to follow as our popcorn example today. Continuous learning is for sure the best asset you can build. As we wrap up this explainer, I really want to leave you with a final thought to ponder. Think about this. If this simple equation meticulously tracks every single dollar of a tiny little popcorn stand, ensuring nothing is ever lost or unaccounted for, what does it reveal about the balance of the world's largest corporations? When you look at a multi-billion-dollar tech giant or an international retailer, their entire empire is still resting on this exact same foundation. Assets equal liabilities plus equity. You now hold the key to deciphering their true financial health. So go pull up the balance sheet of your favorite publicly traded company and see what you can discover. Keep learning, and I'll catch you in the next explainer.